In mere hours, American equity markets hemorrhaged $3 trillion, wealth that vanished faster than most thought possible. Not gradually, not through careful unwinding, through violent cascades that obliterated value built over years in a fraction of that time. Trading terminals glowed crimson. Investors sat paralyzed. Nest eggs crumbled. And beneath all those numbers, something more dangerous surfaced: raw terror. This was no ordinary pullback. This was an alarm bell, a seismic jolt in the financial system extending far past lower Manhattan. When a market this massive begins hemorrhaging, consequences never remain confined to exchange floors. They infiltrate employment, they distort pricing, they invade ordinary households. Right now, you are not consuming another crash documentary. You are entering the opening chapter of genuine financial distress. Here is what the mainstream narrative overlooks. This disaster did not stem from a single catalyst. Instead, pressure accumulated silently across months. Technology equities ballooned beyond reason, inflated by enthusiasm surrounding artificial intelligence breakthroughs. Corporate borrowing climbed to perilous heights precisely as borrowing costs stayed elevated. International capital fled American holdings at accelerating speed. Underneath everything sat a vulnerable global system already strained by conflict, protectionism, and logistics breakdowns. Throughout this video, you will discover precisely how $3 trillion evaporated. You will grasp the authentic catalyst driving it beyond surface level reporting. You will observe panic transmission from institutional players to individual savers. You will understand potential consequences for your employment, your nest egg, your household budget, whether or not you have ever purchased a single share. But wait, you will also uncover quieter indicators most coverage ignores: the abrupt surge in forced liquidations, the peculiar bond market activity occurring simultaneously, the strategic withdrawal by major institutions from volatile positions weeks ahead of headline chaos. These are not merely peripheral facts. They are breadcrumbs. When assembled properly, a far more revealing pattern emerges. Because this transcends declining share prices, it concerns shattered trust. Enterprises postpone capital allocation. Families curtail consumption. Lenders tighten underwriting standards. That is the mechanism transforming market panic into economic contraction. You will also understand why this crash carries a different texture than previous ones. Why hype around artificial intelligence made the bubble more delicate. Why geopolitical friction has complicated any recovery. And why the coming months will determine whether this becomes a brief convulsion or extended financial turbulence. When trust breaks, markets bleed into Main Street. Remain through the final segment because we will reveal which indicators to monitor moving forward. Not speculation, not alarmist theater, but tangible metrics professionals employ to assess trajectory. This is not designed to frighten you. This is about arming you. This is about arming you with knowledge. Markets may be in free fall, but understanding creates advantage. Those who comprehend chaos always emerge more resilient once order returns. You are watching America True Desk, where we dissect global financial developments using plain language, with zero jargon and zero hype. If staying ahead of economic turning points before the crowd matters to you, subscribe immediately and activate notifications. Let us navigate this storm together. American equities did not merely decline. They imploded in a fashion that destroyed trillions in capitalization within an astonishingly compressed time frame. This was no gradual erosion. It was a brutal, concentrated plunge, striking virtually every major market segment simultaneously. Total destruction reached into the trillions as liquidation pressure swept through sectors, annihilating months of appreciation within days. The Nasdaq, dense with technology holdings, absorbed some of the most savage punishment. Tech giants that previously lifted indices began dragging them downward instead. The S&P 500 mirrored these losses closely, reflecting damage across diverse industries spanning finance, healthcare, energy, and consumer discretionary. The Dow Jones Industrial Average, traditionally viewed as a barometer of American industrial might, also plummeted dramatically. Confirming this extended beyond speculative growth names alone. Even historically stable defensive sectors got swept into the carnage. At certain junctures, markets experienced their steepest single-session collapses in years. Trillions disappeared within one trading period as terminals displayed uninterrupted red from opening to close. Circuit breaker thresholds drew intense scrutiny. Volatility measures skyrocketed. Transaction volumes exploded as fear drove countless participants toward indiscriminate exits. Within just days, prosperity accumulated over years simply ceased to exist. Yet this was not confined to one catastrophic session. Losses compounded over multiple weeks. Every tentative bounce attempt met another liquidation wave. Buyers attempting to catch falling knives quickly discovered floors collapsing beneath them. Confidence eroded with each failed stabilization. Institutional allocators began rotating capital toward havens. Bond dynamics shifted unexpectedly. Cash allocation swelled. Hedge operators slashed exposure to high beta positions. Retail participants responded viscerally. Numerous selling amid panic, watching portfolios evaporate rapidly. The velocity of this wealth destruction was amplified by algorithmic execution and automated systems, responding to deteriorating technicals and momentum indicators. Once critical support levels fractured, machines intensified the descent. Social platforms and financial media magnified anxiety as losses dominated every feed. Even veteran operators acknowledged the pace felt unusually violent, as if markets were repricing fundamentals instantaneously. The collapse did not materialize from nowhere. Among the most potent catalysts came from escalating trade confrontation, particularly between Washington and Beijing. Fresh tariff threats and policy ambiguity rattled multinational corporations. Enterprises dependent on cross-border logistics suddenly confronted rising expenses and unpredictable operating environments. This anxiety immediately translated into valuations. Investors began discounting slower international commerce, compressed margins, and potential countermeasures threatening American exporters and global conglomerates. Simultaneously, markets were already perched on unstable foundations. Numerous stocks, especially within technology and artificial intelligence verticals, commanded extraordinarily stretched multiples. Projections had been extended beyond sustainability. Companies generating minimal earnings carried valuations, assuming perpetual expansion. AI euphoria pumped prices to altitudes fundamentals could not justify. Once downward momentum initiated, these overpriced names led the collapse and fell hardest. Economic anxieties layered additional stress. Warning signs materialized across various economy segments. Manufacturing indices weakened. Household outlays displayed exhaustion signals as persistent inflation diminished buying capacity. Inflation, despite modest cooling, remained sufficiently elevated to sustain restrictive monetary policy. This rendered credit costly for both corporations and consumers. Elevated financing costs compressed corporate profitability while simultaneously restraining household spending, delivering a compound blow to growth forecasts. As these elements converged, market psychology shifted violently. Terror supplanted optimism. Once initial liquidation commenced, it activated stop-loss mechanisms, margin liquidations, and forced selling. Investors employing leverage faced mandatory exits, injecting fuel into an already raging inferno. Others witnessed collapsing prices and scrambled to preserve capital before deeper losses, abandoning long-term strategies. Social platforms and news networks amplified this hysteria. Negative narratives propagated at light speed. Whispers moved valuations within moments. Crowd psychology seized control. Rational analysis yielded to emotional reflex. Fear feeds fear. Each drop fuels the next. Each decline bred additional panic, and additional panic generated steeper declines. This was not attributable to any isolated variable. It was a convergence of trade policy fears, unsustainable valuations, economic deceleration signals, and mass psychology simultaneously striking markets, converting pressure into comprehensive financial rupture. When trillions evaporate from equity markets, damage never remains quarantined within brokerage statements. It radiates into the tangible economy through wealth evaporation. Investors observe portfolio contraction and abruptly feel vulnerable. Retirement accounts decline. Capital reserved for future objectives loses potency. Consequently, individuals grow risk averse. They postpone major acquisitions. They reduce expenditures. When millions of households execute this simultaneously, Economic velocity decelerates. Corporations absorb impact even more acutely. With valuations collapsing, capital raising becomes more challenging and expensive. Businesses defer growth initiatives. They freeze headcount additions. Some initiate workforce reductions to preserve margins. This triggers cascading effects. Diminished employment means reduced earnings. Reduced earnings means curtailed spending. The deceleration becomes self-reinforcing, subtle initially, yet profound. The linkage between equity markets and broader economic activity operates through confidence and credit availability. When stocks crater sharply, financial institutions grow cautious. Lending standards tighten. Corporate debt pricing rises. Small and mid-sized enterprises, heavily reliant on borrowed capital, feel the squeeze. Fresh investments get shelved. Innovation decelerates. Economic momentum dissipates. As this persists, recession concerns intensify. Forecasters begin downward GDP revisions. Companies lower earnings guidance. Certain sectors enter stagnation where expansion falters and job creation withers. Even absent formal recession, probability of sustained economic weakness rises. This disruption also crosses borders. The United States anchors global financial architecture. When American markets tumble, international investors rebalance holdings. Capital evacuates developing economies. Foreign exchanges react accordingly. Currencies weaken in fragile nations. Commodity valuations fluctuate as demand outlook shifts. A crisis originating on Wall Street begins touching Europe, Asia, and beyond. Multinational operators suffer from contracting American consumption alongside declining international appetite. Export-oriented nations witness order cancellations. Tourism and hospitality verticals feel slowdown effects. Banks with international portfolios face mounting strain. What begins as domestic market implosion rapidly becomes global economic contagion, extending well beyond American frontiers, where retail investors currently maintain greater market exposure than any recent historical period, and smartphone trading platforms rendered investing accessible, instantaneous, and fashionable. Millions of everyday citizens deposited savings into equities, index vehicles, and retirement instruments. Many entered during sustained bull runs when appreciation seemed guaranteed. When the crash struck, it did not exclusively impact affluent investors or institutional entities. It reached educators, administrative professionals, entrepreneurs, and young workers who entrusted markets with their aspirations. For countless individuals, these were not abstract losses. This represented capital for housing, education, and golden years suddenly contracting. Companies also endure pressure, particularly technology-centric firms. Modern enterprises depend on intricate international supply networks spanning continents. When markets convulse, logistics suffer, expenses escalate, financing grows scarce. Tech companies already priced for exponential trajectories now confront decelerating demand, rising overhead, and shareholder pressure concurrently. Some freeze recruitment. Others quietly prepare workforce reductions. Innovation budgets contract. Breakthroughs decelerate under financial duress. Consumers respond to these shifts almost reflexively. Observing market carnage, they lose assurance. They question job stability. They curtail discretionary outlays. They delay substantial purchases like residences, vehicles, and devices. Credit utilization slows. Financing applications drop. This hesitation permeates the economy, impacting merchants, producers, and service providers. Diminished confidence transforms into diminished demand. International investors are equally vulnerable. Foreign capital reacts swiftly to instability within dominant American markets. Investment flows evacuate riskier territories towards safer instruments. Emerging economies endure acute stress. Their currencies depreciate. Their exchanges tumble sympathetically. Borrowing expenses climb. Nations dependent on foreign investment begin experiencing capital drought. Even individuals who have never owned stock can still feel repercussions. Employment prospects can narrow as corporations reduce hiring. Goods and services pricing can shift due to economic slowdown and currency fluctuations. Savings vehicles and pension schemes can suffer because they frequently maintain indirect market exposure. The crash permeates the system quietly. touching wages, living costs, and financial security through channels many fail to anticipate. As volatility subsides, two broad trajectories emerge from current conditions. One scenario involves markets eventually establishing a floor. Selling intensity diminishes. Panic begins cooling. Valuations stabilize following weeks of intense liquidation. Opportunistic buyers gradually return. Long horizon investors begin entering, attracted by compressed multiples. Over time, confidence tentatively rebuilds. If economic indicators avoid further deterioration, a gradual rebound may materialize. Not explosive recovery, but methodical, difficult ascent as trust regenerates and fundamentals improve. The alternative scenario carries greater peril. Current declines could represent merely the opening phase of deeper correction. Should negative economic releases continue accumulating, the sell-off could extend. Additional companies could deliver disappointing guidance. More investors could flee toward safety. Credit availability could tighten further. In such circumstances, the initial $3 trillion destruction may expand considerably, with more severe ramifications for employment, consumption, and corporate viability. Markets could remain unstable for prolonged duration, oscillating sharply as pessimism and optimism contest for dominance. Critical signals will reveal which direction gains probability. Corporate earnings announcements will demonstrate whether enterprises continue expanding or beginning to struggle. Deteriorating profitability often foreshadows extended troubles. Government statistics matter substantially. Rising job losses indicate businesses are retrenching. Consumer sentiment surveys expose how households perceive their financial futures. When confidence erodes, spending contracts. When spending contracts, companies feel impact across multiple verticals. Policy interventions will also prove pivotal. Central banking authorities may adjust benchmark rates. Governments may deploy stimulus mechanisms to support activity. These measures can either restore calm or fail to revive confidence depending on execution and magnitude.